If you're 30 years old and holding 40% bonds in your portfolio, you're probably making a mistake that could cost you hundreds of thousands of dollars by retirement. And if you're 60 and still 100% stocks, you're taking on risk you may not be able to afford. Getting your asset allocation wrong in either direction is one of the most expensive mistakes an investor can make. And yet almost nobody talks about how to actually do this well in a Canadian context. Today we're breaking down exactly how your stock and bond mix should evolve from your 20s through retirement, why the old rule of thumb you've probably heard is outdated, and what the evidence actually supports instead of just tradition or gut feeling. Here's why this matters. Asset allocation, the split between stocks and bonds in your portfolio, is one of the single biggest drivers of your long-term returns and your risk of loss in any given year. Pick an allocation too conservative in your 20s and 30s and you leave decades of growth on the table, growth that compounds and becomes very difficult to make up later. Pick one too aggressive in your 50s and 60s, and a market downturn right before retirement can permanently damage your retirement plan in ways that are almost impossible to recover from. This isn't a minor tweak, and it isn't something you can fix with clever stock picking. Research consistently shows that asset allocation explains the vast majority of the difference in returns between investors over time, far more than which specific fund or stock you pick, or how well you time any single trade. You've probably heard the old rule: subtract your age from 100, and that's your stock percentage. So at 30, you'd hold 70% stocks. At 60, you'd hold 40% stocks. This rule was designed decades ago when life expectancy was shorter, bond yields were meaningfully higher, and retirements typically lasted 10 to 15 years rather than 25 or 30. Today, with Canadians routinely living into their 80s and 90s and needing a portfolio that lasts closer to 3 decades into retirement, that formula is simply too conservative for most people, and following it can quietly cost you a significant amount of retirement income. A more modern, evidence-based approach, and the one we'll walk through today, generally runs closer to 110 or even 120 minus your age. Let's get into the 3 stages that matter most, and what the actual data supports for each one. Section 1. Your accumulation years, roughly ages 25 to 45. This is the stage where time is your biggest asset, arguably even more valuable than the money you're contributing. If you're in your 20s or 30s and investing for retirement that's 25 to 40 years away, you have decades to ride out market volatility, and history shows those downturns, however painful in the moment, have always eventually recovered. A portfolio crash in any given year is largely irrelevant when you're not touching that money for decades, and in fact it's genuinely beneficial because you're buying more shares at lower prices through regular contributions, a concept known as dollar cost averaging. For this stage, a heavily equity-weighted portfolio, often 90 to 100% stocks, is appropriate for most Canadians and is supported by decades of return data across market cycles. A simple, globally diversified index portfolio, something like XEQT or VEQT, gives you exposure to Canadian, US, and international markets in a single fund, with a small allocation to bonds if it helps you sleep at night during volatile periods, but it's genuinely optional at this stage from a pure return standpoint. The mistake we see most often here is investors holding 20 or 30% in bonds far too early, out of a misplaced sense of caution or advice that no longer fits their actual time horizon, and quietly giving up meaningful long-term growth in exchange for stability they don't actually need yet. Section 2. Your mid-career and pre-retirement years, roughly ages 45 to 60. This is where your allocation should start shifting, gradually and deliberately, not all at once and not in a single panic-driven move. As retirement moves from a distant concept to a visible target, roughly 10 to 15 years out, you start introducing more bonds to reduce volatility and begin protecting the portfolio you've spent 2 decades building. A reasonable, evidence-based target by your mid-50s might be somewhere around 70 to 80% stocks and 20 to 30% bonds, using something like a globally diversified asset allocation, ETF, such as VGRO, or building your own mix with a broad equity fund and a Canadian aggregate bond fund. The goal here isn't to eliminate risk entirely. You still likely have 20-plus years of investing ahead of you even after retirement starts. It's to smooth out the ride, so a bad year doesn't derail your plans right before you actually need the money. This is also the stage where incorporated professionals should be thinking carefully about how corporate investments, RRSPs, and TFSAs work together as one combined portfolio, since your allocation strategy might reasonably look different across each account, depending on tax treatment, time horizon, and how the funds will eventually be drawn down. It's worth noting that this shift doesn't need to happen on a rigid schedule. Some years you might move a few percentage points toward bonds, other years you might hold steady, depending on how your broader financial picture, income, expenses, and other assets are evolving. The point is directional, not mechanical. Section 3. Retirement and beyond, roughly age 60 and up. This is where a sequence of returns risk becomes the central concern, and it's arguably the most important concept in this entire video. That's the risk that a market downturn in the first few years of retirement, combined with you now withdrawing money instead of contributing to it, can permanently damage how long your portfolio lasts, even if long-term average returns over your full retirement end up being perfectly normal. For this stage, many Canadians land somewhere around 40 to 60% stocks, with the balance in bonds and cash equivalents depending heavily on other income sources like CPP, OAS, and any workplace or defined benefit pension. The specific mix depends heavily on your personal situation, and there's no single number that applies to everyone. Someone with a defined benefit pension and modest expenses can likely afford to stay more aggressive than someone relying entirely on their investment portfolio for income. A common and well-supported approach is holding 1 to 3 years of expenses in cash, or short-term bonds specifically, so you're never forced to sell stocks during a downturn to cover living costs, letting the rest of the portfolio stay invested for continued growth over what could still be a 25 to 30-year time horizon. So how do you actually put this into practice? A few evidence-based principles to take away. First, allocation should shift gradually over years, not in a single dramatic move triggered by a birthday or a scary headline. Small annual adjustments as you age are far less disruptive and far less likely to lock in losses than trying to time a big shift around a specific event or market condition. Second, your allocation should reflect your actual risk tolerance and financial situation, not just your age on a chart. Two 50-year-olds with different incomes, expenses, pension coverage, and other assets might reasonably hold very different portfolios, and both could be entirely correct for their own circumstances. Third, the specific funds matter far less than getting the broad stock-to-bond ratio right. A simple 2 or 3 fund portfolio using low-cost, globally diversified ETFs will outperform most complicated strategies over the long run, largely because it keeps costs low, keeps you diversified, and keeps you from making emotional decisions during volatile periods. If you're not sure where you currently stand, the simplest first step is figuring out your actual stock and bond split across every single account you hold, TFSA, RRSP, FHSA, and any corporate or non-registered accounts, added together and viewed as one combined portfolio rather than looking at each account in isolation. Most people are genuinely surprised when they see what the real number works out to. If this helped you think about your own allocation differently, hit subscribe. We're building out a full library of videos like this one to help Canadians actually understand what they're doing with their money, instead of guessing or following outdated rules of thumb. And drop a comment letting me know what decade you're in, and where your current stock and bond split sits,